Hey, Andrew Faldy here, and in this video, I'm going to tell you about trading consistency. All right, I'm a professional trader. I'm consistently profitable. As you can see right here above my finger, that is the list of current positions that I have on, and that is a lot of green, right? Well, I want to tell you how to have more consistent results right now. So watch this video. Hey, Andrew Faldy here, and today we're going to talk about how to increase consistency in your trading. All right, so what we'll cover is first, what consistency does not mean. And these are common misconceptions about what traders believe is consistency, what it means to be consistently profitable, and what consistency actually means, and how to become more consistently profitable, and a giant mistake that I want to help you avoid that traders make very often while working to become more consistent. All right, so first, what consistency does not mean. It does not mean you don't have losing trades. You know that's true. We all know that's true. You're not going for 100% win rate, right? But what often happens is you have some losing trades and you feel inconsistent. But you may be on your way to becoming more consistent. You use that negative feedback, and sometimes that pushes you in the wrong direction away from being more consistent. So remember that. You know it in your head, but make sure you keep thinking about that in the real world of seeing your account fluctuating in value with wins and losses. That a little loss here and there is not negative feedback about what you're doing overall. Got it? All right. So it also does not mean you don't have losing days, weeks, and even months. You can be one of the greatest traders in the world and have losing months. And that's a long time when you go and you work hard, you check the markets, and you're doing your trades, and you're doing your analysis, and you're doing everything quote unquote right, but you get that negative feedback, not just of losing trades, but of a month in the red. That may not mean you're doing the wrong things. You may be doing the things to have consistent growth overall. It just may not have been the month for your way of doing it. But the other 11 months that are going to follow that may be perfect. But if you use 1 month of negative feedback to derail a good plan because you feel it's being inconsistent in the outcome, then you may get off track. All right? So that's an important thing to remember. It also does not mean you have a 51% win rate or higher. A high win rate is often associated with consistency. And you do not have to have a high win rate. 51 may not sound high, but it's more than half. You do not need to have more than half and up to 99 or 100% win rate to have consistent results. Okay? We'll talk more about that in the next slides. It does not mean you are always happy either, and no matter what happens. So consistency is not always this constant state of bliss and satisfaction with the outcome of every single day. I will tell you from my experience that it does shift. In my first year, around 2010, as I started trading, my first year was terrible. Lost 6 figures and did very poorly. And my dissatisfaction, my time spent dissatisfied versus satisfied, was something probably like 95% of the time I was dissatisfied with the result. But I held on to that 5% where things were actually seeming to go the right way as just enough to fuel me through that year to keep on going and finally make the turn. And now it's completely reversed. Now it's about 5% of the time I'm disappointed. It doesn't mean I have a 95% win rate. It doesn't even mean 95% of my days are profitable, but my satisfaction in how everything is going and what I'm doing and how everything is performing is 95% of the time very satisfied. 5% of the time there's a technology problem, a human problem, or something goes on where it's irritating. I don't like it. It happens. It's not going to be 100%, okay? So those things happen. Get through it. But I reflect when I go through those short periods of time, I reflect and remember that I used to feel that way almost all the time. and now it's rarely, okay? And it does not mean you know what is going to happen next all the time. You don't need to predict or know when and how much and what instrument, what market is going to do what over the next day, month, year, etc. You don't have to know these things. If you have just enough edge to be in the right things and you have asymmetric reward, again, we'll talk about that soon, then you can have consistency in your output and in your results. All right, so let's talk now. Those are things that it does not mean. It kind of just pulls away a bunch of stuff, but doesn't really add any value. So let's get into what it does mean and how to be consistent. Okay, your account, to be consistent, means your account is moving up and down in a steady pattern with higher highs and lower lows. Okay, let's read that again because it's very important to let that sink in and understand. Your account is moving up and down in a steady pattern with higher highs and lower lows. What does that not mean? What's missing from this? Okay, it doesn't mean it's moving up all the time. We just talked about that. It doesn't mean it moves up a little, down a lot, and then climbs back slowly over time, and then makes a little bit more, and then drops some more, and sometimes has enormous wins, and then huge losses, and then you get kind of scared, so you cut your size, and then it's making small amounts of change. Consistency means the amount of ups and downs is consistent. And what you want over time is that the ups are larger and the downs are smaller. That is what consistency is. The downs are still in there. Sometimes you even stair step down over the course of days, weeks, or even a full month, maybe even more months, depending on your time frame and strategies. But over time, the big picture is that the stair stepping motion is very smooth, very consistent, and moving upward. Now let me show you an exact, specific example. You ready? This is the stock market over a period of time. Okay, it's about a year. All right. And what you see here is very inconsistent. So our job as traders who want to be consistent in our outcome is to take the input, the instrument that we're working with, the stock market or other markets, if that's what you're using. You take an extremely inconsistent market. What do we have here? We have multiple down days at the beginning. We climb back very slowly over time. Another dip. You see the size of each bar each day is sometimes very consistent and then sometimes enormous, both down and up. Very inconsistent subject matter, but we want a consistent outcome. Sorry, I just knocked a cup over there. And so what we got to do is take that and turn it into results that look like this. And when I say a specific example, like I just told you, this is the actual equity curve of a live strategy we are trading in the markets that uses a broad-based index ETF of the market I just showed you. And that 1 year is about the last 10% of this chart is the outcome of that very inconsistent market. We are able to take an inconsistent market and make it a consistent result in profits and losses that stair step in a very consistent amount of up and down. You do see that this over time, the stair steps and the amount of volatility does change over time. This is showing a compounded return. So it's showing you as you have more profits, you take more size. As you have more profits, you take more size. Okay. And if you have losses, you take less size. All right. So it's a compounding and reverse compounding strategy. That's the only reason why you see any variation in the amount of up and down, because it's using compounding. If we did not compound this, you would see very, very consistent amounts of as it moves up, it's a certain amount. As it moves down, it's at a certain pace, and up at a certain pace and down at a certain pace and climbing up over time. And what you will see, this is, by the way, an over 20-year long equity curve. So what do you see here? Yeah, months with no profits, months that are down, and definitely some downticks, and definitely some downticks that are not totally comfortable if you zoom in and look at just those. But this overall picture is the outcome that we want of consistency and moving the right direction using a market that is not consistent and not always moving in the right direction. All right, so how do you become more consistently profitable? First, you need to learn strategies with positive expectancy and asymmetric reward. All right, what's missing from that phrase? What's missing from that phrase is super high probability. That's not the most important part. All right, learn strategies with positive expectancy. If you're not familiar with that term, expectancy just means that if you take a number of trades, say 100 trades, and you average the results, it's a positive number. It doesn't mean 51% or more are winners or 90% are winners. It could be that 10% are winners. Now, I don't like that low of a win rate, but to make the point very clear, if you take 100 trades and 10 of them are winners, and you average out all the results and it's profitable, that's what you're looking for. That's the most important part. And what I prefer to see, and what's so important to have consistent results year in, year out, decade in, decade out, and over the whole span of your career, is to have asymmetric reward in your account. Asymmetric reward means however you slice and dice it, average loss, average win, max amount of potential catastrophic loss versus max amount of potential amazing win that could happen at any given point in time. Your reward is bigger than your risk. On average, absolutely, over time, etc., every way you look at it, the reward is bigger than the risk, and over the course of 30, 100, 300 trades, they average a profit. Okay? The other part that's very important in this phrase is that it's strategies plural. All right? We'll talk more about that in a second. The next step when you learn strategies that have positive expectancy and asymmetric reward is that you need to prove they are valid with hundreds of past examples. This is just the next step. Don't get stuck at this step. I used to get stuck here and spend months and months and months trying to prove things historically and not move them into the real world. This is a short process. You can do this in a matter of hours or days. Prove that they are valid with hundreds of past examples. Also, what we do in our community and what I help traders do is I provide that information. So I go through that whole process of finding strategies that are profitable, proving they are valid, delivering the data of hundreds of data points and variations of that strategy to show it has edge in the past and moving forward in time. Then next, very important, try to break them. Try to break the strategy. All right, that's another term for that used is called robustness. Okay, that it's strong, difficult to break. Try to break them by making small changes and seeing if they still would have made consistent profits. So you have one strategy that it uses a 45-minute chart and it only trades between 11 and 3 p.m. and it has to look for this specific indicator of a setting of 13 and 22 or something like that. And you can't trade on the third Friday of the month and all these different things. You have all these different rules in there and it would have been fantastic. Well, great. Take one of those rules out and see the result. Yeah, sure. Maybe it's not as good, but was it just a complete loser with that one rule? Or if you change one rule, say if the settings of your indicator were 13 and 22, make it 15 and 21. Does it break it? Does it just make no sense because of that? If it's so sensitive to such a fine-tuned set of rules, the probability that it's curve fit, meaning that's just one specific thing that happened to sidestep this loser and catch this winner and hold this one a little bit longer to force the returns to be positive and attractive, then the likelihood of that working in the real world moving forward are very, 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 very low. Okay? So what you need is no matter which way you do it, it works. And some versions appear to be really great in the past, but that's not what matters. What really matters is however you do this, it tends to work well. Okay? Next, make sure you are accounting for slippage and commissions. Okay? This is like the boring things. You got to throw this in there because I've seen it happen many times. I have people submit strategies to be funded and traded live, and they look amazing, but I know immediately, because I know the time frame and the market and the type of strategy and the the shape of the equity curve that just looks flawless. And I say, I'm guessing you don't have slippage and commissions in here. Yeah, that's true. Yeah, I don't have that. But, does that make a big difference? Yes, on your time frame and in the market and the type of strategy you're using, it's going to make a huge difference. Go add that. You'll see for yourself. They add it and they come back and say, yeah, it's not as good as I thought. So make sure you have that in there, and that will be very important so you don't learn the hard way why things don't work. And execute live in the real world. Very important here. You ready? With the intention of gathering accurate data. Okay? Again, what's missing from this phrase? Not with the intention of forcing a profit or seeing that something new or something is changing and then adapting to it and moving forward and trying to maximize a win here or cut a loss earlier here or add size on this dip because it looks like it's at support and throwing all this other stuff into it because you're watching it live. Execute it live in the real world with the intention of connecting the real world information to the past examples and seeing if the trend continues. All right? If it's going to lose, you just need to know that. If you intervene and force profits, then you've learned nothing that's going to help you be consistent moving forward with many strategies that have positive expectancy and asymmetrical reward. So let it run as planned, gather the data, and move to the next step, which is this. You scale up, that means add size to the passing strategies, and scale out, meaning reduce your size, if not close it completely, scale out of losing strategies. All right? Sounds simple enough? I know it's like one of those things that's really easy to say and you nod your head and you get it. Yeah, add to your winners, cut your losers, right? But people often don't do that. They often don't do it because they haven't worked all the way down systematically to this point. The prior step is a really hard one to do, to actually just let a strategy run and collect the data and attach it to the edge that you studied and prove whether or not it works. And as you prove if it works, you add to it. And if it's not working, you scale back a little bit. Maybe it's just kind of not as good as you thought, but it could be really good still. So you just, hey, let's step back a little bit and keep watching. And if it just really is absolutely disproving itself, then you cut it and you learn from it. So what happened here? What was wrong with this? Was my slippage actually 5 times worse than I thought it was? Was my strategy overfit? Did the market change? What really happened? Take account for that and learn from it. And when things are working, you take the profits, and you add them back in. All right? Maybe not all of them. Maybe you spread some out. Maybe you take some for income or whatever else you want to do with it. But get those profits back to work. And I've proven it time and time and time again. If you just have 1 out of 10 strategies work, but you scale up a winner and you scale out of losers, the 1 out of 10 can make your whole career. Especially if you go and make 20 and you get 1, then you get 2 winning strategies, and then you make 30, now you have 3 winning strategies, and you keep going, and that's how you become very consistent. All right? And that brings us right to this final point on this slide. Repeat until you have a broadly diversified set of strategies and time frames and markets that are working for you. As of right now, as I present this to you, I currently have over 30 different strategies on different time frames in a variety of stocks and ETFs and commodity ETFs and all these different things that are running. And I run over 90% of them fully automated to ensure that I'm allowing it to just run. All right? And so all of that's going on, and all of those were built out of months and months, if not years, of discovering strategies that work, trying to make sure that they're not overfit, testing them in the real world with a small amount of money, scaling them up, adding more symbols to the strategy, scaling those symbols up, learning another strategy, back testing it, robustness testing it, live testing it, scaling it up, scaling them down, etc. That's the work. That's what we do. And we keep building and we build and we build until you have widely diversified. What does widely diversified means? That means you have high probability strategies, you have short-term strategies, you have multiple time frame strategies, you've got strategies in high beta stocks, in broad-based ETFs, in commodities, in equities, in debt instruments, all sorts of things and all sorts of time frames. You have bearish strategies, I have hedging strategies, all these different things running. And now the outcome is, I don't know what's going to work from day to day, but over time, meaning from week to week, from month to month, the account rises, and when it falls slower than when it rises. It rises faster than it falls when it falls. And the outcome is consistency and good profits. All right? So now I want to tell you the giant mistake traders make when working to become more consistent. I did briefly mention this to you before, and I want to drive it home so you also avoid it. All right? Because traders normally associate win rate with consistency, they seek out strategies with the highest percent of winning trades. Okay? Sound good? Have you done that before? Does that sound familiar to you? This is a giant mistake. It does not mean having a high win rate is a bad thing. It means to ignore things with low win rates and be fully attracted and fully on board and just only focusing on things that have 80, 90, 95, 97, 98, 99% win rates is extremely dangerous. And here's why. While some high win rate strategies are very good, high win rate almost always comes with asymmetric risk. Okay? If you have a momentum strategy that has high probability, high win rate, then you're probably scalping. If you have a mean reversion strategy that has a high win rate, then you are probably experiencing or setting up every single trade with asymmetric risk and small amounts of reward. If you have an income strategy, if you have a pairs trading strategy, if you have a spread trading strategy that offers 80, 90+% win rate, then you are often holding at all times you're in the trade tail risk that is multiples of any potential gain you could see over the course of a trade, a day, a week, a month. All right? And you can lose months, if not years, of gains in one losing trade, in one losing move, in one outsized move that goes the wrong way. All right? What is the point? This is a question I have for you to make sure drives this point home. What is the point of having a 95% win rate for 9 years and 11 months if you blow up your account the next month? It's happened before. There are stories. I won't mention names. That's not the point. I don't want to distract you with any of that. But you know, you've probably heard the stories about it, and you don't want to be that story. Nobody will feel sorry for you. If that happens to you, you work hard, you grow your account over 10 years learning some high win rate strategies, and then you blow it up in the end. You'll just be another story. It may be such a small story that very few people even hear about it. Maybe a story say, yep, I used to trade, did pretty well for a while, and XYZ happened. This event happened. This change happened. Whatever it is, there'll be something that happened. And because you held asymmetric risk, you'll be blown out. All right? Consistency is more than just from week to week, month to month. It is to ultimately, over the whole course of your career, is to have your account at a much higher level, and the trajectory of that growth of your account and of your assets stair steps consistently up and down in a good pattern. And maybe it's okay. I don't mind this. If you have the outsized amazing win every once in a while, great. But what you cannot do is sit on strategies and continuously put strategies into your account, into the markets, that at some point in time could have a tail risk draw down that destroys it. All right? Hold asymmetric reward, and often asymmetric reward will have under 50% win rate, and that is fine. Focus instead on strategies that steadily move up and down with consistency. It's okay that they move down. It's okay that they have losing trades. It's okay that they have 2 or 3 losing trades in a row. If they're tiny little losses that don't take long and you can make it all back in one new trade, you're awesome. You're in a great position. Strategies with 30 and 40% win rate can provide amazing returns. All right. Now, what I believe to be fully diversified and have a great basket of strategies, you'll have some high win rate in there. You'll have some medium probability. You'll even have some low probability that just have massive wins that make up for all the tiny little losses that come. That is, to me, a beautiful basket. Ultimately, though, for me, I actually prefer an overall portfolio win rate that's actually around 50 or even less than 50% win rate, because the asymmetric reward, I'll have 1 week, I'll have a couple of weeks out of the year where a trade will run and make half the return of the year. That's awesome. I love to see that. And the rest of the time, beautiful stair-stepping patterns in the trading. All right. And then every once in a while, a massive return. That's what you can get with a little bit lower win rate. All right. So I want to help you learn a strategy, a specific strategy that provides consistency, which is smooth and steady returns. Your P&L being smooth and steady. And it comes with clarity. Clarity is 100% clear. Buy and sell rules, including what, when, and how much. And confidence. The confidence to follow the rules, scale your size, and grow your account faster. All right? So next to this video, there should be a link, either in the description or a button or a link or something. Right next to this video is a link to another video that's much shorter than this one, that's going to tell you about these 3 points and help you understand what it means to have consistency, clarity, and confidence with the specific strategy and one of the specific strategies that I use. All right. So thanks for watching this. Wherever you are, give it a like, a subscribe, a thumbs up, anything like that. And then immediately go watch that short video that's going to help you learn about this strategy. Okay. That's it for now, and I'll talk to you soon.